Welcome back to Radio Rothbard. I'm Ryan McMagan, editor-in-chief at the Mises Institute, and this is our one annual live episode of Radio Rothbard, coming to you from Mises University here at the Mises Institute. My guest today is Mark Thornton, who I haven't had on lately, but certainly if you're a devoted Radio Rothbard listener, you know all about Mark. You also know about his own work at the Mises Institute. He's a senior fellow at the Mises Institute, has been for a very long time, probably more than 30 years going on, or about that. And so I have Mark on here today, and we're going to talk about several different issues, but I always like to talk to Mark in terms of economic trends. Mark keeps an eye on things like inflation, employment, money, gold, a lot of those sorts of topics. So we'll cover some of that today. But first, Mark, thanks for joining me today. How are you?
Ryan, I'm doing great, and it's a pleasure to be back on Radio Rothbard with you today. And I was really glad that I showed up early for your talk on the French Revolution, because I think it was really spot on. And, you know, we're entering I think, a revolutionary type era of where society is a little bit unstable, and where there's a lot of grievances, and where there's a lot of division in society. And in my sense, the theory of revolutions is that very often it's the good guys that start the revolutions. They see the problems, the moral and economic problems. They want to do something about it. But ultimately, there's a coup in the revolution, which you pointed out very wonderfully, and then the bad guys take over, and the revolution ends in a terrible end result, like with the communist Soviet Revolution, with the French Revolution, and even with the American Revolution. You know, it was the real good guys, the anti-federalists, that really led the charge for change in America. But ultimately, you know, there was a coup during the American Revolution afterwards, and we ended up with the worst possible end result of the ones that were being put forward at the time. So we don't really want revolutions. And I think everybody in here and out there can contribute by helping us make the moral case for the free society, to point out the problems with government in our lives, and also to provide solutions. So there's a lot of work ahead.
Well, you pointed out that we're in a period where people have a lot of grievances, and especially if you have young people in your life, like I have couple grown children now, right? Who'll be looking for jobs. They're dealing with things like inflation. And so I'm sympathetic, to say the least, to a lot of these challenges that people now face, especially driven by inflation, asset price inflation, especially in home prices, rents, that sort of thing. And you will note, right, in all of these cases, the French Revolution, the Russian Revolution, which was really just a coup, the American Revolution, economic factors are always playing a very big part. Because after all, if everybody feels fine economically, why have a revolution, right? If you feel good, you're getting richer, there's no problem. But that a lot of people don't feel that way right now. And I think it would be nice to talk about like some of those issues that I think that are really affecting people. And I think the topic that keeps coming up is inflation.
Yes, and inflation is at the heart of the matter. But I think particularly young people are right to be upset, given that my generation has accumulated $40 trillion in debt. My generation has bankrupted the Social Security system. My generation has made housing prices unaffordable with various subsidies to themselves. And now housing is unaffordable for a lot of people, and higher education also, where government provided all these subsidies and drove up the cost of higher education and drove down the quality of it, just like they've done with healthcare. They've driven up the cost, driven down the quality, And now all of a sudden, all these young people are looking at the bill for all of these things. Well, of course, all of those bills are going to come due in the form of inflation. And of course, that's the government. In the Austrian paradigm, inflation is the government printing up too much money. It's either at the Fed, the Treasury, through the banking system. They expand the money supply all the time in order to finance spending, but also to refinancing the national debt. And of course, the health care, Social Security, and all of those other things feed into the general expense that government has to turn over our resources in the form of the paper that they print out. And then, of course, we only know about it as taxpayers and consumers and just people in America in the form of higher prices. So it's not surprising that the government and the Federal Reserve and all of the mainstream economists out there, they want to label, first of all, inflation as the effect, as rising prices, rather than what the government is actually doing, which is printing up money and forcing prices higher eventually. And then they want to do all sorts of things like adjust the statistics so that the rise in price does not look as bad as it is. And of course, the new Federal Reserve Chairman, Kevin Warsh, one of the big things on his agenda to get us back to the target rate is by just simply getting rid of the old statistic and bringing in his favorite statistic, which happens to be measures inflation at 50% less than the current rate. And of course, that current rate and the current target of 2%, most people I talk to out there in the economy, they don't want the 2%, first of all. But then again, the government and the Fed have not met their 2% target in, I don't know, is it 5 years now?
It's more than 5 years, yeah.
So, it's not surprising that it's all really boiling down to inflation and the government trying to cover up the shell game that they're playing on the American people.
Yeah, we should note that in the Federal Reserve Act that Congress adopted back in the early 80s or very late 70s, it states that the goal of the Federal Reserve will be 0% inflation. After 1988, they had a time frame that they wrote into it back then. And then the Fed, just contrary to their legislative mandate, decided, no, it's actually 2%. We're going to do that. We're going to do 2%. We don't care what Congress says. And then they can't even hit that, right? It's been years since they hit even the 2%. And instead it's around 50% higher than that. And it's been a long time. So that's a significant factor. And we should know too, right? In this context, when we say inflation, we mean monetary inflation. If we're just using the word by itself, if we're talking about price increases, we're talking about price inflation. We do make that distinction. Could be monetary inflation, could be price inflation. But if we're just using inflation by itself, we mean monetary inflation, because that's how Mises would have used the term. But while you're talking, you've been talking about how this is impacting a lot of young people in many cases. So now I know the answer to this question, but I'm asking you, are you implying, Mark, that inflation affects different groups of people in different ways? And if so, how and why?
Well, I think that's the great advantage of the Austrian approach, is that we don't look at the overall aggregates of anything. We really look below those aggregate statistics and look at what's happening with various groups in society to figure out what's actually going on. When you look at the aggregates, you can easily be misled about, if somebody were to tell you, okay, gross domestic product for the nation is growing at 2.5%, and the stock market is growing at 8%, then everything on the surface, it must be just fine. In reality, of course, things are not just fine. As a matter of fact, the main problem that we're facing in terms of this division, as well as working families, working households, is that this inflationary process has been very, very beneficial to the most wealthy classes that control most of the assets and most of the wealth in society, whereas the working class is falling further and further behind. As you know, and Ryan's articles on all these things are must-read material that come out on Mises.org in terms of staying up with what's going on statistically with the money supply and prices and all that. But these working households are falling further and further behind because their wages are increasing very little, but the prices of goods and services in the economy are rising faster. And the sequence of change from a monetary stimulus by the Fed, and of course, everybody knows this, but nobody really puts it together. But when the Fed, say, has a surprise rate cut, the things that it impacts in a positive direction are things like stock prices and real estate prices. So basically, the whole wealth category gets a big advantage. So that if you have wealth and you can leverage up wealth by borrowing more money at those lower rates, then all of a sudden your income, your wealth statement, your net worth is going to go up. But somebody who doesn't have a lot of wealth, a lot of assets, is going to get no positive feedback or very little positive. And if you were working in the luxury good industries, for example, or maybe in the high-tech industries, you might be advantaged. But basically, the broad stroke of working households are not going to see any advantage. They're going to get the higher prices for things like gasoline, housing, food, clothing. All of those prices are going to go up. And then the last thing that goes up, and this is, of course, theoretically true, but also historically true, is the last set of prices that goes up is wage rates in the economy. So the inflationary process is constantly leaving the working class and working households a step behind in the whole process, where that same inflationary process from the Fed is helping the government finance the debt, yes, but it's also helping the people who are in the top 1% of wealth or the top 10% of wealth, and it goes down into the top 20% of wealth of income households. So it's definitely helping some people in society and hurting others. Now, in Austrian theory, we start there with the Cantillon effect, which has been discussed at some length at Mises University, and it's basically the person who gets the money first is the main beneficiary, and then everybody else comes afterwards. So the first person to receive it, maybe the second or third person to receive it, but if you're down the timetable of who gets the money, you're going to end up losing. And then, of course, we've also been talking about the Austrian business cycle theory, which is the same thing, except the money in that first step is coming through the Federal Reserve. It's first going to the government and then going to Wall Street and asset markets and the banking sector. So you can see that the cards are stacked against the average American and really the broad stroke of Americans who are working, but with maybe not a lot of assets and probably with a lot of debt too. So it definitely affects people differently.
And so this is a factor in that K-shaped economy we hear about, right?
Yes, it's the explanation. And of course, I do a lot of podcasts and as well as my own minor issues podcast. And so on my podcast, I've talked about the Cantillon effect in several episodes going back in time, and I've talked about the K-shaped economy in several episodes going back in time. And so these podcasters who are generally promoting gold and silver and things like that, investment podcasts, they've seen that and they realize that the Austrians have an explanation for the K-shaped economy that nobody else has. If you read articles about the K-shaped economy, there's no discussion of what causes it. They just say, well, the wealthy are getting wealthier, the poor are getting poorer, and what we really need is to tax the wealthy, and we need to provide various subsidies for the non-wealthy, for the working class. But if you leave out the cause, you have no idea how to really solve the problem. And so that has caught on with the people who interview me on other podcasts, and it's been kind of a way for me to get in there and talk about Austrian economics and talk about this little chunk of economic theory that Austrians have that nobody else really does have. And I've found that the audience and the hosts find these pieces of Austrian theory to be very thoughtful.
Yeah, whenever I hear these economic analyses that in no way include the central bank when they're trying to talk about the problem of capitalism, late stage capitalism, right? Just kind of the go-to phrase for anti-capitalists nowadays. It's amazing how rarely they even talk about the central bank, which manages and manipulates the most important price in the economy, the price of money. And they're relentlessly trying to force down interest rates. And if you're not mentioning that, I just don't see how you could have any sort of meaningful economic analysis.
Well, the Fed is a very powerful group, and they have they dedicate enormous resources to what I would call propaganda. And they basically bought off every economist who works in macroeconomics, monetary theory, money and banking, everybody who's high up in those areas in the economics profession, or works at an academic journal in those particular areas as editors or as members of the editorial board. They've all worked for the Fed, or they've all been on a research grant from the Fed. And the Fed pays extremely well. So you don't want to, shut the door on the prospects of being risen up economically and professionally by the Fed and the affiliated institutions. And so you tend to leave out those kind of things. I've noticed that there are a few prominent people in the area of monetary economics, and they seem to change their tune as soon as they're retired. As soon as they're not in the rat race of academic journals, all of a sudden they say, well, I think those Austrians have a good idea there about the Great Depression or something like that. So the Fed has an enormous amount of money. They spent an enormous amount of money on staff and research wings and publications and grants and visiting positions at the Fed, and they try to cover that all up. But if you don't include the Fed, you're absolutely right. There's no way you can understand what the problem is. You can't diagnose the problem. And so the average person, especially in the journalistic accounts, is left accepting the idea that, well, we need new taxes and new regulations and new subsidies. We need more and more government interventions, when it's precisely government that's gotten us into the problem in the first place. That's a general rule of government intervention.
Well, I know from experience that, like you, if you go on a lot of these shows that want to talk about the issue of money And often, if they're promoting gold and so on, they want to know, okay, what direction is the dollar going in? And then we get into the more speculative thinking about what's happening in the near future. But let's do that. Let's speculate about where things are going. And of course, the Fed is only one central bank among many. The dollar is only one currency among many. But as long as we've got policy going that is inflationary, where it's forcing down interest rates, which will require some monetary inflation in most cases, isn't that going to then devalue the dollar? Or is that just relative compared to other currencies? What should we be keeping our eye on in terms of trying to guess about what is going to happen to the dollar in the near future and beyond that even?
Well, as someone said, the US dollar is the least dirty shirt in the laundry. And the other fiat currencies are very often, with the exception of the Swiss franc, maybe a couple of others, the Norwegian kroner, and there's a few others that are actually better, more stable, less reckless than the US dollar, but basically every other currency is even more reckless. So you can't look at what's called the dollar index, which is just comparing the US dollar to all the other currencies, because the main currencies that are being compared are the Japanese yen, who are hyperinflators, the British pound, which their economy is going right down the tubes as we speak, and the euro, which is on a teeter-totter that's likely going to break and crash. So we're comparing the US dollar against other highly inflationary, highly unstable currencies. And so the dollar index is actually very misleading. But we do know that if we look at the dollar on the true gold standard, where $20 was equal to an ounce of gold, and now an ounce of gold is equal to $4,000, that our dollar is really only worth about a half a penny of what it used to be on the gold standard. And there's no prospects for that trend to stop falling, and there's no prospects for it to start rising. I mean, there's no indication whatsoever that the dollar is going to get magnificently stronger in terms of its absolute purchasing power. And there's every reason to believe that the pace of decline in the value of the dollar is going to increase because of that $40 trillion of debt, the $2 trillion annual deficit, which is not a cyclical thing anymore, it's built in. And now the interest on the debt is more than $1 trillion. And that's the fastest growing of the three categories. So, you have to expect that the actual purchasing power of the dollar is going to continue to decline, and it's likely to decline at an even faster pace. So,
well, and let's just draw those two dots together too, in case people are unfamiliar with this argument, right? Is the reason that high debt and high debt service leads to a further devaluation in the dollar is because the regime and its central bank, they need low interest rates. So they can't enter into a hard money situation, right, because they need to keep forcing down interest rates, and that leads to more monetary inflation. Because you can imagine, right? They've got to pay interest on $1 trillion, or they're paying interest of $1 trillion right now at current relatively low interest rates. You can imagine what would happen if they just, we're going to let interest rates float. We'll let the market determine interest rates. Even if it just went up 30%, that would massively increase the monthly, the quarterly, the annual payments that the government now has to make on its interest. And you could then see that you would enter then a sovereign debt type crisis where you're not able to pay your bills, right? So it's built in because the central government has to have low interest rates, right? So there's really no hope then of seeing a turnaround and embracing some sort of hard money policy. I guess unless maybe they just simply said they weren't going to pay the debt, or they were going to pay the debt on pennies on the dollar now, but that would come with other problems.
Yeah, that's not very likely either. But we've seen just this week where the long bond, the interest rate on the U.S. government long bond has gone above 5%, and the negative impact that's had on the stock market. So in order to really stabilize the value of the dollar, the Federal Reserve would have to undertake a policy like it did with Paul Volcker in the early 1980s when I was in college, and he raised interest rates to 15%. And of course, if you think the government would have a hard time financing the national debt before that, you can imagine what it would be like of them trying to roll over the existing debt and the new debt at 15%. It would just blow up the entire world economy post haste. And so, that is definitely a significant problem. They don't really have recourse to that kind of thing at the present moment. Floating the interest rates and seeing where they would go is probably about the most radical thing we would expect them to do, but nothing along the lines of what Paul Volcker did, which temporarily stabilized the U.S. economy and put us on a path to solid economic growth during the Reagan administrations of, say, the 1980s. But yeah, that's definitely a problem. And the problem, as I suggested, they're not really doing anything about any of those problems, starting with the spending. Nobody's talking about spending cuts. Nobody's talking about moratoriums on increases in any of the budgets. They're not even really debating the bills in Congress anymore, and they haven't been for quite a long time. They just pass these continuing resolutions where nothing is examined, nobody goes through the accounting in Congress to see what could be cut, what needs to be saved. They're not doing that basic financing that everybody else in the world has to do. Every other household has to come to grips with their credit card debt and their mortgage and the bills that they have to pay. That's what the average American is doing right now. They're having a heck of a time with making their mortgage, making their credit cards, making their bills, paying all their subscriptions. They're having to cut. They're having to shave. They're having to cancel subscriptions, refinance their mortgage, and all sorts of things just to stay afloat. But the federal government is engaged in none of that.
Just looking at the geopolitical issue, however, do you see, so you noted that the dollar is the least dirty shirt in the laundry. So do any of these other efforts at circumventing the dollar, at replacing the dollar as some sort of global reserve currency, right? You hear about the BRICS currency proposed and those sorts of efforts. Is that really going to have any sort of impact on the dollar? And if not in the short term, maybe in the long term? I mean, what are the factors there? And is the dollar really threatened in any way?
Well, China and India, Russia, and an increasing number of other countries are interested in an alternative. They don't like the fact that the dollar is the monopoly currency. Now, as a trading currency, it's likely that the dollar is going to continue for quite some time. The BRICS countries are currently introducing a new trading system so that international transactions don't occur on the U.S.-dominated electronic system. And they're also establishing gold trading mechanisms so that these international trades in other currencies can take place, and they're backstopped with gold. And so this is all stuff that's going forward, and it's in the self-interest of these other countries. And of course, that's going to hurt the dollar and hurt the position of the United States government. And then there's the reserve currency question, the fact that central banks held U.S. government debt as its reserve currencies to back up their own domestic currency. And right now, that is under threat as well as India, China, Russia, Turkey, and a bunch of other countries, around the world. 25 of the top leading economies are all adding gold to their reserves of their central bank to back up their own currency. And gold just became, once again, for the first time in half a century, the number one reserve on the balance sheets of these central banks. So that is also moving in that direction. And the third thing I'd like to point out is that this, it's so stupid that I can't even really describe it, but the situation in the Persian Gulf, where the United States has joined Israel in attacking Iran, has set up a situation where it's not only threatening our oil supplies and chemical supplies and fertilizer supplies and all sorts of other things, including diesel gasoline. I hope nobody in here has a diesel gasoline car or truck, but we all depend on 18-wheelers and tractors harvesting our food and so forth. So we're all going to be very negatively impacted by that. But in terms of money, all of these countries in the Persian Gulf are now, they were the ones that supported the petrodollar. They were trading their currency for the US dollar, creating a demand for the US dollar. And they want to get out of that. And a lot of other countries that have been very negatively impacted across Asia on the periphery, and then, of course, those countries that I mentioned, Japan, China, India, Russia, Turkey, and so many other countries that have been adversely affected, where they've had to shut down factories, they've had to shut down sectors of their agriculture or plant crops without fertilizer. They've had to stop letting people commute to work, and all sorts of negative impacts. They're no longer really the great friends of the United States that they once were. And they're no longer really all that supportive of buying our government debt or holding our dollars. And of course, the same is true with our former friends and allies in Europe. So that's a very unfortunate thing regarding the future demand and therefore the value of the US dollar.
Well, as a final question then, what is the role of understanding economic theory and being able to make sense of all of this? I mean, you'll have some people seem to think, well, you can just look at statistics, you can look at trends, and you can come away with that with some sort of understanding. But don't you need good, sound economic theory to understand what's really happening with currency, to realize how people are maybe being exploited by the economic system? There's no substitute for good theory here, right?
Well, for me, there's certainly not. I mean, if I didn't have the use of economic theory, I don't think I'd be invited on to any of those podcasts. Because I don't have anything different. It could be just anybody showing up and talking about the statistics and then venturing guesses as to how that's going to affect the precious metals markets and that kind of thing. So I've personally found it's increased the demand for my services because it's a unique contribution to their audience, And, the hosts even say, oh, that was a very thoughtful conversation. What does that mean, a very thoughtful conversation? Well, it means that the host and the audience has to think about it. And that's really what economic theory asks us to do. The theory of the law of demand, for example, you have to, in your mind, you immediately go to, well, at high prices we buy less, and at low prices we buy more. Okay, so that's the most fundamental component of economic theory. We have to think about it, and we all realize it's true. And so these audiences realize that what I'm telling them about the Cantillon effect or the K-shaped economy is actually the explanation. And so I found it very helpful. And as we've been pointing out, these purely journalistic accounts really don't tell us the causal factors, and therefore they can't generate any solutions to the problem because there's a disconnect, really, or there's no connection, I guess, between the problem and the solution. And so I found it very helpful in what I do, certainly, and that's what I do in the classroom as well, is focus in on economic theory as it affects policy in the current day or back in time in economic history. It's the big crucial advantage of Austrian economists because, we can't possibly know everything there is to know about economics and all the subdisciplines and keep up with all the statistics and the econometric modeling and everything else. It's theory that guides us so that Austrian economists can actually, have something to say in any conversation because it's theoretically based and it's adaptable. The law of demand is adaptable to any situation, every situation. It doesn't matter where in the world it is or when it happened. It could be about the long ago past, or it could even be about the future. And so it's a great tool. And of course, that's what we spent the whole week on really here. We tell stories and we make applications, but it's basically trying to demonstrate the importance of economic theory in our everyday lives.
Well, Mark Thornton, thank you for joining me today. We appreciate having you on. And of course, if you are unfamiliar with Mark's work, be sure and check him out at Mises.org. That's MISES.org. He's got a number of books. He's got his own podcast, of course, which I would recommend. It's a shorter podcast, so very easy to listen to. So I would recommend the Minor Issues podcast as well if you haven't been listening to that. So thank you everyone out there for listening. We'll be back next time with more, so we'll see you then.
Thank you.